Let's bring in Tola Abimbola, investment analyst with AfriInvest. Is joining us live now to review the market, the fourth trading day. Tola, good morning. It's nice to see you on Skype.
Good morning, Watson.
Thank you very much. We appreciate your time. Let's talk to the anticipation of the MPC meeting in about a few days down the line and the inflation expectation as you guys sit down and watch how traders are reacting to the Treasury fixed income market with the bonds. Put this together for us. Give us your outlook ahead of that crucial meeting. We'll get FDC Abimbola to talk to us later on. Go ahead.
Yeah, definitely. Thanks, Watson, for the question. Well, the NCC will be meeting against the backdrop of higher inflationary pressure. We at AfriInvest, we are forecasting headline inflation to increase to 9.5% for the month of October. Besides that, economic growth has been declining. We recorded a growth of 2.35% for the last quarter. That's the second quarter of the year. And third quarter growth projection is expected to even come out much lower. So against the balance of factors, the MPC will probably want to balance the heightened inflation expectation as well as the need to stimulate economic growth by losing monetary policy. But by and large, we expect that the MPC will probably be holding on to the current rate that are obtained for all the policy instruments. But talking about the fixed income market, as you earlier observed, yields increased yesterday, and there were majorly reactions to investors, which are majorly investor expectations of the CBN to resume OMO moves next week. Besides that, looking at the liquidity level of deposit money banks, we observed that liquidity level dropped significantly within the last few days, majorly due to the subscription for the DMO bond auction that occurred 2 days ago. And besides that, the report of the DMO auction revealed that although we saw that the marginal rate dropped for the 2020 instruments and the 2024 instruments that were on offer, one of the instruments sold at a rate that was above the market, secondary market pricing. So in a way, that led to some repricing in the fixed income market yesterday, which was responsible for the sell down pressure experience.
Let's look at this, Tola, in terms of the JP Morgan, Barclays Bank, a portion of Nigeria's government bond from the emerging markets bond index. And again, we're seeing this very strong demand from the local end, especially from banks. 155, about 155 billion naira yesterday. On Wednesday, I beg your pardon, the DMO bond auction and the rate at which, the stop rate at which the debt office issued those, reopened those 2 tenor papers. What does this tell us about how we move forward at the local end of the bond market now that we're out of the global space, so to speak?
Well, the domestic bond market is majorly dominated by domestic players, the pension fund administrators, insurance companies, and banks as well. So, although the fact that we were removed from the bond indices, they were quite unfortunate, but that will not in any way lead to the pricing of fixed income instruments. Valuations are majorly determined by the level of liquidity in the financial system. And as the CBN has suspended more auctions, liquidity has been quite robust, and that has also boosted demand for fixed income instruments. As you can see from the DMO bond auction that was conducted 2 days ago, we saw that marginal rate also declined to about a little bit above 10% for the 2 instruments that were auctioned. So that shows that for the pricing of fixed income securities, the fact that Nigeria was removed from the bond indices is not really having any effect on valuation.
Finally, is it likely that from where we are right now, should be able to see single-digit yields on FGN bond papers moving forward into 2016? That would be desirable, isn't it, Tola?
Definitely, but it will be desirable. From our end, we remain very bullish on the fixed income market. Generally, when we see an increase in liquidity levels, three things should follow. You should see fixed income use declining. You should see equities markets rallying due to lower discount rates. And we should see the credit market easing a bit in terms of rates. But right now, most of these money banks are considering the risk environment in the real economy and are holding back on granting loans. As at Q3, we observed that most of the banks did not grow their loan book. So if banks are not willing to play in the risky real sector in terms of loans, and we are not seeing the equity market rally due to the macroeconomic condition that has weakened the earnings performance of these companies. The only other play for deposit money banks as well as the pension fund is the fixed income market. So what I'm saying, if liquidity stays this way and the sequence continues to hold on to its position or to intervene by OMO auctions, what we should see is rates trending further downwards. In fact, there are even speculation out there that the CBN may probably lower its monetary policy rate in a way to boost the economy. But another factor that may also come into play is the supply of fixed income securities. The current administration, as we have observed from the recent statement, has an expansionary mindset, especially fiscal policy mindset, and with the revenue base generally it is constrained by the decline in oil prices. The only way the government can raise money will be from borrowing, and that means increase in supply of fixed income securities. So if the government makes through or goes through with its program of boosting of a fiscal stimulus of boosting the economy, that may result in higher supply of fixed income securities and consequently lead to higher yield. But we are not yet certain on that, so that's why we still retain our bullish outlook for the fixed income market.
Okay, thank you so much, Tola Akingbami, for those thoughts of yours, giving us that's a really widespread depth into that conversation. Tola Abimbola, we appreciate your time. One of the research analysts at Afrinvest, one of Nigeria's investment banking and securities trading firm.